It's a thematic rich environment. I would say the opportunity set is wider today than it's ever been. We had a once in a 100-year global pandemic. We had once in 80-year European land war. We have had now once in 100-year global trade war. And they all came in rapid succession, 2020, 2022, 2025. And it's kind of shaken things up.
Hi, and welcome to JP Morgan's Making Sense. I'm Eloise Goulder, and today I'm delighted to be joined by Fawaz Chaudhry, who is CIO of Horizon Global Partners, which is the equity thematic team from Fulcrum Asset Management. So Fawaz, thank you so much for joining us here today.
Thank you so much. It's a pleasure.
So Fawaz, could you start by introducing yourself and your background?
Well, originally I'm from Lahore, Pakistan. I did my O-levels, A-levels there, born and raised there. And when I was 18, I got a full scholarship to go to MIT. And that basically changed my life, as you would imagine. I remember my uncles, aunts, 20 cousins, all at the airport seeing me off. My mom put me in a suit and tie. She saw movies, that's how gentlemen traveled. MIT was fascinating. I loved it. I did a triple major, computer science, finance, economics, also threw in a master's for good measure. I graduated and joined Morgan Stanley's M&A department, did investment banking for 4 years, and moved to the buy side. Came to London Business School to do my MBA and settled in London, which I love. Graduated and joined Macquarie to do long-short equities at Macquarie on the prop desk. And I started running this strategy 15 years ago at Hadron Capital in 2011 with Marco D'Atanasio. Moved over to More Capital. That was 2013 to 16. Worked with Eloise. And I've been at Fulcrum now from 2017 onwards. I'm a partner, and I started running my strategy within Fulcrum's flagship product, Diversified Absolute Return Fund, and then spun that sleeve out as a separate fund 4 years ago. And then we've now rebranded my team as Horizon Global Partners, as you just said. And I'm very excited to bring the strategy to your group. Yeah.
Fantastic. And I understand you really focus on global equity themes. Could you explain your investment process and your investment philosophy?
So the thought process is to identify themes and trends globally, and then having a very rigorous, structured access to that thematic view. And that by that I mean in a relative value format, you hedge out all the risks you don't want to carry. This can be equity beta, market risk, but sector risk, style factor risk increasingly these days, or even positioning risk, so short interest or crowding. So we hedge out the risks we don't want to carry and are left with a trade in which we have access to the pure thematic that we want to have access to.
Makes sense. And thematics as an investment style across the industry is growing, I think it's fair to say. Why do you believe it's so important and so valuable to be harnessing themes today?
So it's about breadth. You need to connect the dots across sector to sector to identify how one new idea or theme affects another sector. These days, it's a thematic rich environment. While I've been doing it for 15 years, I would say the opportunity set is wider today than it's ever been. I would completely agree. A lot of top-down macro shocks playing out. We had a once in a 100-year global pandemic. We had once in 80-year European land war. We have had now once in 100-year global trade war. And they all came in rapid succession, 2020, 2022, 2025. And it's kind of shaken things up. And you have to have some top-down view into any security. Otherwise, you'll just be buffeted by those forces. So the opportunity set is rich, and I feel like I'm actually built the strategy to take advantage of it.
It's incredible, the shocks we've witnessed over the last 5 or 6 years. The fact that we've seen the pandemic, we've seen the European land war, we've seen the global trade war, tariffs, all relatively rare events in the context of history. What do you think the implications of all of these are for equity markets?
The big implication of this was these three kind of independent events all happen to be inflationary. If you think about the global pandemic that came in 2020, last one obviously was 1919, that created shutdown services in all the developed world, and there was a demand for goods. We had a manufacturing shortage and with a goods inflation cycle. You could say it's temporary. In fact, the central banks called it transitory, that it will roll over, except within 2 years, we got then hit with the European land war. And that was an energy crisis from Russia. So that was an inflationary shock as well. And then we got hit with tariffs, which is again inflation. So we got three different independent shocks, all pointing in an inflationary direction. We've come to the point where a lot of prices are up 40, 50, 60% from 5-6 years ago because three different inflationary shocks. It's caused the 40-year bond rally to come to an end because with inflation, it's the bond owners who are the losers. And global yields in Japan, elsewhere, are starting to rise as bond owners have turned out to actually be the big loser from all these inflationary shocks. But it's kind of jolted the system. I mean, right now, you can get 4.5 locked in for 30 years in treasuries, and investors need and want a higher return across all asset classes because the risk-free return has now risen from these shocks. And there's been a move back into equities, move back into risk. So I would say it's exciting times, and that rise in long-term risk-free rate is actually what's shaking things up a lot.
I mean, the pace of structural change over the last 6 years has clearly been enormous and, as most clearly represented in the rising bond yields and the ramifications from that. The other big structural change has obviously been AI, the scale of technological change, possibly a deflationary force over the medium term. What's your view on the impact of AI and who are the relative winners and losers?
So AI is going to be a bit of a seminal force, a general purpose technology that will basically permeate through all the goods and services we use. We will go beyond the AI apps to AI becoming like electricity or railroads or the internet, but it's actually bigger than the internet because it's actually disrupting services itself, and services is a much bigger part of the economy. So we are on the way to build the manufacturing footprint for AI, data centers, which are needed to actually run AI. But ultimately, everything you buy, whether you buy clothes, whether you go for a coffee, even the coffee machine will be fine-tuned through AI. The point being, in every single thing we use, AI will be used. And that'll bring productivity. Now, productivity, as you said, is going to be a disinflationary, unlikely to be deflation, but most likely disinflationary force. But that means that real rates, R star is going to rise. That means real rates can be higher, back to the higher rates. This is good for the world, but it will be disruptive and it will be pretty quick. So generally speaking, in the past, the cycles where this kind of disruption has happened, there's been backlash as well. Let's see if that happens, if there's a lot of social upheaval on the back of it. There are winners and losers out of the whole AI thematic, and it's the shakeout is only just starting. People keep asking me, are we nearing the end of the AI cycle or the bubble? I mean, we are just starting. We're in year 4, year 3, and this is going to be a multi-decade seminal technology which permeates through society.
What a wonderful time to be picking themes.
Indeed.
So in the context of everything you've just discussed, these three ultimately inflationary forces that we've seen over the last 5 or 6 years, the geopolitical pace of structural change, and then on top of that, AI and all of the ramifications and ripple effects of AI, what would you say on a medium-term view are your highest conviction themes?
So AI is basically almost like a move back towards the hardware, putting the silicon back in Silicon Valley. So effectively, we're back to the chip now. And the value add anyone can bring right now is make a better chip. Whoever has the best chips can make the best AI, large language models. And the value is shifting from software application layer to the hardware layer. And the highest market cap companies in the world, TSMC, it's Hynix, Samsung in Asia, ASML here, or NVIDIA, Broadcom, these are all hardware chip companies. So we're back to the chip. We're back to figuring out who has the best chips, who can make the best chips. And if I was to give advice to new graduates, I would be saying, go do electrical engineering, not computer science. So it's kind of interesting how things shift.
But this is clearly the now, but if you look a few years ahead, will that remain the key place to be?
I do think that the value is sitting with the hardware for the next definitely 3 to 4 years. At some point, the application layer will kick on again, where the new application will come which will truly harness AI. And a lot of people use the analogy of the internet. So we're in like the mid 90s. I mean, and so some of the seminal companies that emerged from the internet, Google was started in 99 and Meta in Facebook was started in 2004, or Amazon launched AWS in 2007. These came much later after the backbone had already been laid, the fiber and etc. So right now we're laying down the backbone, and the giants of AI, is it going to be OpenAI? Is it going to be Anthropic? Or is it going to be new companies which don't even exist right now? So we'll find out. I would actually venture there'll be a lot of new businesses that will still appear who will truly harness AI in our day-to-day lives, and which haven't even been started yet. But certainly near term, the free cash flows, the spend is going to these chip guys. So if you look at in the 90s, Cisco became the largest company in the world by the end of the 90s. Because we didn't know who will win, which .com company will win, but it'll be a lot of routers.
Yeah, absolutely. And when you look at the market cap of global equity markets right now, how many of these companies would you wager are going to be the net beneficiaries versus the losers? And in terms of trades to make right now, is it more about identifying the winners or identifying the losers?
So a lot of our alpha comes on the short side. In fact, more than half. And the reason is thematic investing. It's almost synonymous with long investing. People even think of thematics as what are the long-term winners.
Yes.
I think what are the long-term winners or long-term losers. So there are thematic tailwinds to businesses. There are also thematic headwinds to businesses. And finding those structural losers, the melting ice cubes. That has been a much easier to harness than on the long side. On the long side, you get retail participation, valuation challenges, crazy rallies, volatility high. And on the short side, it's much more hope generally available to businesses. They'll get the new management in. They never get too cheap. So it's just easier to sit on shorts, structural shorts, for many, many years. Currently, we are looking at the services side. I mentioned software, who are actually losing from some of these trends. And one of the main things that we are focused on is productivity. AI is bringing productivity. There's a hiring freeze at the moment. Staffing companies are not seeing much businesses. So we are shorting services, staffing, taking advantage of where are the AI losers as the shakeout is happening in the world. And those positions have actually been some of our biggest winners in terms of those trades.
Yes. And when we look by country and by region, I'd imagine there are more AI losers in certain pockets of the globe. What are your views on that?
That is true. I mean, some of the biggest software giants are in America, actually. In the which index has the biggest percentage of market cap coming from software, that's US. And guess what? S&P 500 underperformed MSCI ACWI for the first time in a long time last year. So the hardware supply chain is winning. So that means Asia is coming back to the fore. Kospi was up 70% last year.
Yeah.
So the hardware is coming back in the tech landscape to Asia and even Europe, rather than the last 2-decade kind of outperformance from US on the back of the software dominance in America. So big shakeout. Asia's back.
Totally. And quite counter to the consensus view of at least 6 to 12 months ago, when I think US was definitely seen as a winner on tech without this differentiation necessarily between hardware and software.
Yes, there's a shakeout happening, but overall, this is a big positive to productivity, to the global economy, and hence to equities, etc. globally. Yeah. A lot of the investment in AI, the data centers are being built in America. And hence, American GDP is actually getting revised up. So ultimately, that must flow through into the entire economy, because while the Asian supply chain is building all this stuff, yes, but they're building it all. It's all being sent to America, all these data centers and etc. So that will permeate through the economy in terms of construction, in terms of power, grid, etc. So I would say overall it's just good for equities. And it is interesting that when I talk to people, the general consensus seems to be that AI is a bubble, equities are expensive. So the real contrarian view I'm taking is they're right tail risks, not left tail risks. What if AI is real? Are you under invested? I mean, this is good for equities if AI actually plays out the way I'm describing it.
And what about other asset classes? I mean, you've spoken about bonds and the fact that ultimately the inflationary environment we've been through has been bond negative. What about commodities and precious metals, which have been incredibly strong this year and last year?
Yeah, gold and silver precious doing great. We still like them. 2 weeks ago, gold reserves at central banks overtook treasuries for the first time in 70 years. So the central banks are at the forefront of buying gold. That trend started on February 2022. Russia saw all its US treasuries, your bonds, and etc. confiscated, and the only reserves that really counted were precious gold, and that really triggered a move by all central banks globally to move out of treasuries, bonds, and JGBs and into gold. And the pace of buying has been very strong and consistent, and often volume targets being set, not even a dollar amount targets, that they will buy certain tons of gold. So this is price insensitive buyers. So you have to find a marginal seller at what price is someone willing to sell. And it's not going to be a central bank who is hoovering it all up. So I think that it is fair that gold will keep rallying on the back of it.
Yes, absolutely. You've touched on the retail investor a few times. Obviously, the retail investor's been heavily involved in precious metals, especially silver this year. We track the number of posts on social media associated with equities and those asset classes. And in fact, we saw the number of posts in silver peak at 20 times the average number of posts over the last 5 years. What's your view, Fawaz, on the retail investor more generally? You mentioned that they are heavily invested in themes. Does that sometimes support your thesis? Because ultimately you've got another marginal buyer for those themes.
Flows do matter, sentiment matters, obviously on the long side mostly, not on the short side as much. So they are participating. We do follow like the retail flow index, where which securities are getting the retail flow. Clearly, money supply has grown significantly since 2020, whether it was QE, balance sheets are bigger. The money supply has actually expanded significantly. So there is a lot of capital out there, and when it moves prices. And we do keep an eye on it. And then you mentioned silver. You can see when it comes out, retail flow, it can come out very quickly as well. And we've seen some massive pullbacks in silver. But a lot of the fundamentals of silver are very different from gold, and is linked to solar panels. And a lot of the thrifting in solar panels for amount of silver has already happened, and it's very difficult to do more thrifting and reduce the amount of silver in solar panels. And we've now come to the point where the cost of a panel is so low that in big swathes of the world, unsubsidized, solar is the cheapest energy of the world. So in my home country, Pakistan, if you go there, every rooftop has solar panels on it. Same with India, or if you go to Africa, Asia, people are unsubsidized, putting up solar panels on their roofs, and that's silver. And the silver is so little that as the price of silver doubles or doubles again, it doesn't really move the cost of installation of a solar panel. The wafer, the cell, the module, the whole panel, the installation, the inverters, it's de minimis cost to it. But it's become the cheapest source of energy in the world. And now, as EVs keep coming, in China, for example, 60% to 80% of new cars sold any month are now EVs. And China is putting up massive amounts of solar panels, solar farms, as its source of energy going forward. We're replacing oil with silver. So, and I said, like, silver is the new oil. You're now running cars on solar. And that's the one metal that matters to that at the moment is silver, actually, that it is making a meaningful impact to in terms of global supply-demand balances. So that will continue.
Yeah, incredible.
Yeah.
So in addition to AI, you mentioned earlier these enormous geopolitical shifts with the European land war, with tariffs. That must be providing a lot of opportunities for you. What are your thoughts?
Well, US used to have, if you rewind back, an isolationist policy all the way till 1942. And they were stuck to that. They were not going to participate in these European wars. And that was a seminal moment, the Pearl Harbor, which changed that. So there was a new world order created after World War II, in which America was involved globally. Previous to that, they had actively made the decision throughout the 1900s, etc. They're not going to get involved, even World War I. And now that security umbrella is being lifted because the cost of that, which is being borne by the American taxpayers and consumers, the benefits are not apparent to them anymore. We're just generations apart from those events which led to the decision to police, the creation of United Nations, and to set a world order. And there was some efficiency gains from it, keep in mind. Japan or Germany and others could spend 0.5% of GDP on defense. Everyone else could spend a lot less. You have one country spending all the money, can have mobile assets going all over in the world, and everyone just kind of then stays put, and you let them police it. And now they don't want to police it anymore. So the US security umbrella has been lifted explicitly by themselves, by their own decree from Europe and in Asia. He called it the Donroe Doctrine, which is a version of the Monroe Doctrine, and they're going to just focus on the Western Hemisphere only. Defense budgets have to rise. It's one of the thematic we've been very involved with, but not just in Europe. This is global. The American security umbrella has also been lifted from Asia. So Korea, Japan, everyone, their defense budgets have to rise. Japan has to formally declare its army, which is called self-defense forces. And it is going to be very different era, resource nationalism. So the rise of trade is kind of peaked and it's going to start falling. And China has now come to the same decision. So China is building its own vertical stack. Very different world from what we're used to. A lot less trade, like things used to be pre-World War I.
Yeah. It's fascinating the way it seems like a complete shift in the global world order. And yet, if you go back over long swathes of history, this is more the norm. And actually what we lived through in a post-World War II era was quite counter to the norm. But it was also more efficient in the sense of global trade per Milton Friedman, efficiency of labour.
Yep.
You know, if we're going back to local supply chains, then it is in many ways much less efficient as well.
Of course. Yeah, it'll be much less efficient. The Malthusian order, I mean, we're basically the comparative advantage order that we are currently living in, where everyone specializes in one thing and becomes the best at it, and then they start selling that. I think Stephen Moran came out and said that we want to move away from this comparative advantage kind of order that we've moved to, where everyone just specializes in what they're good at, to back to everyone doing everything, which is a lot less efficient.
Yes.
But it is more secure.
Yes.
So
there's the trade-off.
If security is what's important, but we'll definitely have some inefficiencies. Now maybe AI can offset some or all of it because the AI will bring some productivity. We are definitely moving to a more vertical stack in every space. Yeah.
Yes.
So I think the biggest, most important question I'm constantly asked is, do I think AI is a bubble? I think that is the most important question everyone is concerned about. I would say no. And AI is real. The data centers investments will not turn out to be in waste. People keep comparing it to the late 90s, the 2000 tech bubble, but it's very different from the 90s. In the 90s, we built out all this fiber optic cable, and we just couldn't get it to the homes. The last mile couldn't be bridged. The fiber optic that they laid down was sitting dark. We just could not light it up. It's so different from that. Every data center is humming, full speed. Every LLMs are being used, and Microsoft, Amazon, everyone is coming out and saying they're supply constrained, not demand constrained. There's more and more demand coming. And the productivity gains from AI itself are so underappreciated. So January of last year, if you asked the best model at the time, and you asked it some question and got an answer and thought it was a pretty decent answer, you can get the same answer today at less than 1% of that cost. This is the pace of productivity change. If you think the answer was good, imagine you spend 1/100th the electricity, 1/100th the NVIDIA cards, and that is the Jevons paradox playing out. The cost of the token is dropping by 100x, but the demand is growing by 1000x or 10,000x. So overall demand is growing faster than the cost because more use cases are coming. Elasticity of demand is so high with the cost falling.
Yeah.
So it's not a bubble. The demand is going to keep growing. The productivity gains are incredible. Like I'm sort of giving you 2 orders of magnitude per year or faster. Which industry you're seeing that kind of productivity? And we will keep finding new and new use cases for AI as the cost of token keeps dropping at such an incredible pace. And all the data centers will be lit up, and It's all about the societal impacts that we'll have to start contending with at some point. Those are the questions, the things that we'll have to contend with. So it's going to cause disruption. But I would say for equities, AI is not a bubble. And generally speaking, I would say it's going to become a general purpose technology and we're on our way. So super exciting times. We will look back at November 2022 when ChatGPT 3 came out and took off as a seminal moment. Similar to Netscape Navigator in 94, but almost certainly even more so than the internet or the internet browser. Yeah. Yeah.
Well, I think on that very optimistic note for equities, at least, we should close. Thank you, Fawaz. It's been such a fascinating conversation, a very far-reaching conversation, also really helping put into context these phenomenal structural forces we've witnessed over the last 6 years. And as you say, it's the beginning, not the end. There are so many ripple effects and dynamics that will happen as a result of the events we've gone through. So thank you very much, Fawaz, for taking the time to speak with us today.
Thank you. Thank you for having me. A pleasure.
Thank you also to our listeners for tuning into this regular podcast series from our group. If you'd like to get in touch or ask questions, please do reach out to us at jpmorgan.com/market-data-intelligence. And with that, we'll close. Thank you.
Thanks for listening to JP Morgan's Making Sense. If you've enjoyed this conversation, share your feedback by leaving a comment or review wherever you listen to podcasts. And be sure to follow our channel so you don't miss an episode. The podcast views do not necessarily reflect those of JP Morgan Chase & Co. or its affiliates, together JP Morgan, and are not from JP Morgan's research department. They do not constitute recommendations or offers to buy or sell securities. Intended for institutional and professional investors, not retail use, it is for informational purposes only. Products and services mentioned may not suit all investors or be available in all jurisdictions. JP Morgan may make markets and trade and discuss securities and asset classes. Visit www.jpmorgan.com/disclosures/sales and trading disclaimer for more disclaimers and regulatory disclosures. External speakers' opinions are personal and not JP Morgan's views. Copyright 2026 JP Morgan Chase & Co. All rights reserved.